Welcome back to our lecture on Chapter 9, Liabilities. We are now going to move on to how to record bonds, notes payable, and interest expense. So basically, a bond is the debts of the issuing company. So bond certificates have all of this type of information: the name, the principal, the maturity date, the interest rate, and the interest payments. Notice the face value, maturity value, and par value of the principal. We're going to go into those. These are types of bonds. You can have term bonds, serial, secured, and unsecured. Secured obviously has some type of collateral associated with it. And then you're going to get it quoted at a percentage of the maturity value. So if everybody has $1,000 face value, that for when it's 100%, it's the same. And then that would mean it's par. If you do a little bit more, in this case you have 15 more, then you have a premium. If it is obviously less than the face value, you multiply it by the price to get your discount. So premium, you know the price is above the face value. And then the premium account has a credit balance, and then the market price decreases towards the maturity value. Now at a discount, the price is actually below the face value, so discounts have a debit balance, and in here what happens is the market price increases toward maturity. At the maturity date, they both equal. Face value and market value are the same. So now interest rates. What we have here is that bonds are always sold at market price, and then we have the present value. And in Excel, you can do NPV, that formula for your net present value. Then you have two interest rates, which is probably a new concept for you. The stated interest rate, which is also known as the coupon rate, that's printed right on the certificate, and it basically tells the cash interest paid to the bondholders. Now, the market interest rate is your effective interest rate, and then this is what the investors are demanding for loaning the money, and this varies continuously. So we have here that assume that the stated rate or our coupon rate is 8%. If our market rate is 6%, we're selling it at a premium. If our market rate is 8%, we are selling it at par, and if our market rate is 10%, we have to reduce it more, so that way it will be at a discount. So let's go through some examples here. We have that Southwest Airlines, they have $50,000 of 9% bonds payable that mature in 5 years. If we assume that Southwest issued these bonds at par value on January 1st, 2014, let's do the entry for the issuance. So our bond issue price is the $50,000, so that's our face value. So we have cash for $50 and bonds payable for $50. Now, suppose that the $50,000 bonds, now we have interest payments that occur on January 1st and July 1st. So our July 1st payment here is going to be for 6/12 of the year. So we're going to take the $50,000 times the 9%. So interest equals principal times rate times time. And in this case, we get interest expense of $22.50 and cash of $22.50 because we had to pay that out. Now we have to accrue the interest for the remainder of the year, which is an additional 6/12. So interest expense, interest payable for the $22.50. Now we actually are making our semi-annual interest payment. So when we make that interest payment, we've already accrued it at the $22.50. So we're going to debit interest payable. We're going to credit cash for $22.50. Now at maturity, which was the 5 years later, you see that they pay off the bonds. Bonds payable is reduced and your cash is reduced. So this is the easiest scenario at face value, how to record your bonds. Now at a discount rate, so now we still have the same information, but our market rate is 10, but we sold it at 9. So basically we have $96,149. And so that's the amount of money we're going to get, $96,149. Then we have to true it up or make it debits equal credits. And we have to record the discount, and we see that the discount is debited for $38.51 to get our $100,000. So if we're looking at the accounting equation here, it's still the net effect, right? We have the $96,149 for the cash, and then here's our two accounts in the liabilities, the bonds. So this is our cash account, and here we have our discount on the bonds, and here is our bonds payable. So, and then you see how it would look on the balance sheet. So we're still going to get to our 96,149. So to get the interest expense at this point, we're going to take the 100,000 times the 9%, same thing, at 612. But now our difference is that our stated interest rate is at 9%, and we're doing the 4,500. And when we do the interest expense, we have the same thing. Now for the interest expense on the first 6 months, we have the 96,149, and then we have the 10% and the 6/12. So here is a bond amortization schedule, and you see all of the interest expense, you see the actual payments, the interest expense, and then the discount and the discount balance. Note that the discount balance has to be 0 at the end, and your carrying value, they will equal at that point. So 0 for the discount and for the carrying value. I highly recommend you put this in Excel. It's a simple formula, right? You're just taking interest expense minus interest payment, and here you are taking the discount balance minus your discount amortization. So this is quite easy to determine in Excel. So here's our semi-annual interest payments at the 6/12, and then here is our true interest expense, where we're taking the market interest rate of 5%, and we're actually taking it based on the preceding bond's carrying amount. So your interest expense will increase as your bond carrying amount will increase as well. I apologize. So here's our discount amortization, where we're taking our interest payment, and then we are subtracting our interest expense, just as our formula here tells us, to get our discount amortization. Notice that this keeps going down, and here we are increasing. So here our balances are going down, and here our balances are getting higher. And basically your bond carrying amount increases from the 96,149 to our face value. So what happens to the 3851 balance of the discount account over the life of the bond issue? Basically, it decreases as it is allocated to the interest expense. And so then you see we have an additional payment. So here's a visual picture of your interest expense going higher and your discount amortization getting to the point that it needs to between your two interest payments over the 10 years. So our journal entries to record these interest expenses and these interest payments for the first 6 months. Here we're going to have our interest expense. We get that amount right here, and then our discount on our bonds to equal the actual interest payment that we are making. So your interest payment will be interest expense plus your discount amortization equals your interest payment. Now we accrue interest and amortize the discount from July through December as well. So we see that right here. So here's our 48, our 323 to add up to our interest payable of 4,500. So what would Southwest Airlines income statement and year-end balance report? So our income statement is going to show our interest expense. We know that that's a debit balance. And then our balance sheet is going to show our interest payable for the 4,500. But let's not forget, we also have the bonds at their discount. And notice that 96,779, we see that, right here. Oops. Right there, 96,779. So that's why I highly recommend you do that schedule in Excel, because then once you add and subtract properly, you don't have a problem. So now let us proceed into an illustration of this. So here we authorized to issue 600,000 of 5% discount, 5% 10-year bond payable. On December 31st, the market rate went up, and so the company issues 500,000 of those bonds, and here's the amount that they received. So we want to amortize the bond discount by the effective interest rate. So no, amortize the bond discount by the effective interest rate. And we have semi-annual payments. So we're going to actually prepare the amortization table, and they're only telling us for the first 4 semi-annual install interest periods. And then we're going to record the issuance of the bond on December 31st, 2014, the first semi-annual interest payment and the second payment in December. So Here we have our bond schedule. So here's the 500,000, and this is the amount of cash we received. So we know the total discount amount. And then once you have your interest payment at the 2.5%, and then our interest expense at the 3%. And if you look, 3% is half of 6, 2.5 is half of 5, because we're making semi-annual interest payments. This should be then relatively easy to get to the 12.5 and the 13.884. So here we're going to record the issuance of the bond, cash for the amount that we received, our discount on our bond, and then our bonds payable. So note, we start off with the numbers we were given. Then the first semi-annual interest payment we have, here's our interest expense, and then here's our discount on bonds payable, because our interest expense is greater and we know that we have to pay $12,500. And then the second payment is going to be the interest expense for $13,926, our discount of $14,26, and cash. So notice how easy this is when we have Excel. So for partial period interest amounts, here we're talking about Google issuing 100,000 of 8% bonds payable at 96 on August 31st, 2014. The market rate of interest is 9%, and these bonds pay a semi-annual interest rates. So here's a few lines of their amortization schedule. Note the 8 is here and the 9 half payments, and then our discount amortization. So here's the 96,000. If you take the 100,000 and multiply it by the 96, you'll get that number, and then we know that 4,000 of it is our discount. So here we calculate 4% of the 100,000, and here we calculate the 4.5%. And so hopefully now you would know how to do this. I would recommend you use this as a guide to prepare it in Excel. So here, when you have to accrue interest and amortize, right? So now we're looking at our interest here. The only difference from our previous example is now you're multiplying it by 4/6. So you have a different amount here, and then your discount, you're also multiplying it by 4/6. So once you know the amortization schedule, you can actually apply our partial period by just adding a time factor. And then the interest payable that we have to pay for 2,667. Now let's move on to our bonds payable at a premium. So here we have similar information, the 100,000 at 9%, but now the issuing price was 104,100 because our market interest rate was 8%. So now we received 104,100, our bonds payable, and now we have our premium account, which is a credit for the 4,100. And note, you see the same effects as we did previously. So our assets equal our liabilities, and very similar in format in the balance sheet. So now we have our same information. Notice 9% annually becomes 4.5%. Semi-annually, 8 divided by 2 is 4 for your semi-annual interest payments. So we're going to take the 100,000 for interest payment at the 9%, and then our interest expense is at the 8%, because that is our market rate. And our amortization schedule is similar. Now we start with a larger amount and a premium, but at the end we still come up with the same 0 and 100,000, which is our total bond. So again, now we're just calculating 6/12, and we are getting 4,500. And here we're taking our interest expense of the 4%, and we're multiplying it by the 104.1 to get our premium amortization. Our interest payment minus our interest expense gives us our premium amortization. Note, we are back to 0 at our premium balance, and then the 104 was issued and the 100,000 at maturity. And once our premium discount becomes 0, we're good. So to record the interest, as we did with the discounts, we're going to do interest expense of $41.64. Here's our $336 bond. Now we're going to debit that to decrease it to make it to 0 to get our $4,500. And so this is just a visual depiction of what you see. So if you're a visual learner, this might help you. And there's another less precise way to do straight line amortization method, which basically amortizes the bond and the discount. And we normally do not do this method quite extensively in business. We stick to the bond amortization schedule that was presented earlier. But if you did have to do this, then you're just going to basically, they're considering issuing bonds at 9% at 96, so 149. So the straight line amortization, where you're just dividing it by the 10 years of maturity. That's all we're doing in this case here. So everything stays about the same, and then our discount goes back to the 4,500. And then when should you retire your bonds or before maturity? Well, if you can relieve any interest payments, or hey, if you can get a lower rate, then you would do that. A callable is basically where the issuer of the bond can pay off the bond at a prearranged price. So it doesn't matter. They can just go ahead and liquidate it on their own. And here we see an illustration of such. And then we have convertible bonds and notes as well, where you're just guaranteed a piece. So here it's still the same notes payable. Here you're having common stock and then additional paid in capital. Notice this is par value. Also, sometimes not as so basically all you're doing here is taking a bond and moving it into notes payable as a reclassing entry. So hopefully this has helped you. We will stop this lecture here and then proceed in the next.